this has been a massive move higher. I remember it was just last year that you were here talking about what the outlook for 2019 was. It seems like you got some of those calls pretty right. You said that the market was going to bottom. How does it feel to you right now, given what we've seen over 2019?
Well, when you contrast where we are today, Dom, it's a totally different picture. Think about it. Interest rates were much higher a year ago. Today, the Fed was in tightening mode, not easing mode. And you had a Fed chairman who was really struggling to find his voice. You know, the trade deal so far had not been successful between China and the United States. And really, the conditions in Europe and other economies were decelerating at a pretty rapid rate. It's just so different now. The Fed obviously completely reversed course and injected a lot of liquidity and continues now to keep interest rates low and is nominally expanding their balance sheet, while economic conditions are starting to improve in the Eurozone. And we're starting to see that in areas like the dollar, for example, which is beginning to weaken. You cited strengthening gold prices and energy prices. That's the inverse of a weaker dollar.
All right, so what has you the most excited? I mean, it was, in hindsight, maybe a little easier to feel good about an upward move when the markets sold off as harshly as they did in the fourth quarter of 2018.
Right.
The base was in place. You're working off a very low level. Moves like that are not as difficult to achieve. Think about the lows of the financial crisis and how we've come back from then. This is now a market that is not exactly cheap. It's also a market that's gone up markedly, the best performance in a decade for many measures. So is it still good to be excited about this marketplace?
Yeah, it's very exciting if you're a stock picker. You know, again, when you look at what the PEs are on the indexes, that's an average. Whereas, you know, we love to look for value, and we can find value in various sectors.
So you're saying that despite the fact that we are seeing some forward valuations, price to earnings pricing next year's anticipated numbers as high as we've seen, maybe going back towards pre-financial crisis, towards .com, that there are still places that you can find value that can provide for upsides like we've seen this past year?
Because the dispersion of the cheaper stocks versus the most expensive stocks is quite high. You have excess valuation in a lot of the areas of technology. You touched on some of the software companies that have done so well. There's valuation issues in some of those companies. By contrast, when you look in the areas of financials and industrials, it's much more attractive. And now, as the Federal Reserve has completely changed course, we're seeing the yield curve steepen. That's a perfect sign for a risk-on type of environment. And now we have the early signs of global coordinated growth. So our exporters out of the S&P 500 will do much better in the context of a weaker dollar environment.
You opened the door with the yield curve.
Yes.
I wasn't necessarily going to bring it up here, but since you did it, I want to kind of move in on that.
Yeah.
Does that then mean financials have been one of the better performers this year?
That's right.
And you'd love to see tech and financials lead the way higher. Does that mean the bank stocks are finally due for that real breakout? I mean, financials have been talked about as a value trade for so long. Is this the year of the banks?
This year, well, 2019.
2020,
2019 has been a year of the banks. I think it will continue into 2020. And when you think about it, having the financials in such a strong position right now, that really bodes extremely well for the overall market. When the financials are doing so well, I just think we have the right economic conditions for banks, a steepening yield curve, a benign interest rate environment. And again, the Federal Reserve is going to be on the side of being lagging when they're raising rates versus leading when that day finally does come. And I don't think it's coming at least till past mid-year, when they'll think about, you know, changing course again and perhaps tightening conditions. But that will only be based off of very strong economic conditions.